Imagine two people, Jack and Mike. Jack loves excitement. He checks stock prices every morning, scrolls Twitter for hot tips, watches YouTube gurus yelling "buy now," and believes he can beat the market. Mike is boring. He invests quietly once a month into one simple index fund. He doesn't watch the news, he doesn't trade, he doesn't panic. 10 years later, Jack is stressed, burnt out, and confused why his returns are average. Mike is wealthy. This story repeats every year in America, and the reason is simple. Index funds beat 90% of investors, not because they are smarter, but because humans are terrible at investing. Let me explain. Investing feels like a game where skill wins, but in reality, it's a game where discipline wins. Most people think the key to investing is picking the right stock, the next Apple, the next Tesla, the next Nvidia, but statistics tell a brutal truth. Over 90% of professional fund managers fail to beat the market over the long term. These are people with Ivy League degrees, teams of analysts, insider access, and billions of dollars. If they can't consistently win, what makes the average investor think they can? This is where index funds enter quietly. An index fund doesn't try to be smart. It doesn't predict. It doesn't guess. It simply buys everything. An S&P 500 index fund owns the 500 biggest companies in America: Apple, Microsoft, Google, Amazon, Coca-Cola, Nike. Over time, America grows. And when America grows, the index grows. That's it. No drama, no genius, no ego. Now, let's talk about why investors lose. First reason, emotions. Humans panic. When markets crash, people sell. When markets rise, people buy. This is the opposite of what works. Studies show the average investor earns far less than the market because they buy high and sell low. Index funds remove emotion. You invest automatically. No decisions, no fear. Second reason, fees. Most investors don't realize fees are silent killers. Active funds charge high management fees. Trading platforms encourage frequent buying and selling. Every trade costs money. Index funds charge extremely low fees, sometimes as low as 0.03%. Over 30 years, this difference could mean hundreds of thousands of dollars. Third reason, time. The market rewards patience, not intelligence. The biggest gains happen on a few powerful days. Miss those days and your returns collapse. Active investors try to time the market. They jump in and out. They miss the best days. Index fund investors stay invested. They capture everything. Fourth reason, consistency. Most investors quit. They stop investing during hard times. They lose faith. Index fund investors keep going, month after month, year after year. This is how compounding works. Money makes money. Then that money makes more money. Albert Einstein allegedly called compounding the eighth wonder of the world, and index funds are compounding machines. Let's make this real. If you invested $500 a month into an S&P 500 index fund for 30 years, you could end up with over $1 million, not because you were smart, but because you were consistent. Meanwhile, the average trader underperforms dramatically. They chase trends, crypto hype, meme stocks, short-term gains, long-term regret. Now here's the part most people don't want to hear. Investing success is boring. Index funds don't give dopamine hits. There are no exciting alerts, no overnight riches, but boring builds wealth. Excitement destroys it. Warren Buffett, the greatest investor alive, has repeatedly said that index funds are the best option for most people. He even instructed that his own wife's inheritance be invested mostly in index funds. If the greatest investor of all time recommends them, why do people ignore this? Because ego. People want to feel smart. They want control. They want to beat others. Index funds don't offer bragging rights. They offer results. And results don't care about your ego. Now let's talk about the 90%. Who are they? They are day traders, swing traders, hobby investors, people who think watching charts equals skill, people who confuse luck with talent. Some win early, then lose later. The market humbles everyone. Index funds accept humility. They say, I don't know which company will win, so I'll own them all. This is the smartest bet possible in an uncertain world. And here's the final truth. Index funds don't make you rich fast. They make you rich eventually. And eventually is how real wealth is built. Not through secrets, not through shortcuts, but through time, discipline, and patience. So the question isn't, can you beat the market? The question is, will you stop trying? And the moment you do, you join the small group of investors who actually win. Let's go deeper, because understanding why index funds win also means understanding how the market actually works. The stock market is not a casino. It is a reflection of businesses producing value over time. When companies innovate, hire people, expand globally, and increase profits, the market rises. Index funds capture this growth automatically. Active investors try to outsmart this system. They believe they can jump ahead of everyone else, but every buy has a seller, and every seller believes they are right. This means for one person to win, another must lose. After fees and taxes, the average active investor loses. Index funds don't compete. They cooperate with the market. This is why they win quietly. Now think about diversification. Most investors put money into a few stocks. They believe concentration equals confidence, but concentration equals risk. If one company fails, your portfolio suffers. Index funds spread risk across hundreds or thousands of companies. One failure doesn't matter. One success lifts everything. This is risk management at its finest, and it requires no effort. Another reason index funds dominate is taxes. Active trading creates taxable events. Short-term gains are taxed heavily. This drains returns year after year. Index funds trade very little. They are tax efficient. More money stays invested. More money compounds. This advantage grows over decades, and decades are where wealth is made. Now let's address the myth of intelligence. Many people believe smart investors beat index funds, but data says otherwise. The smartest minds in finance still fail to outperform consistently. This isn't because they are dumb, it's because markets are extremely efficient. Prices already reflect known information. By the time you hear a tip, it's too late. Index funds don't rely on information, they rely on time. Time rewards ownership. Own the market long enough and the odds tilt in your favor. This is probability, not opinion. Let's talk about behavior. The biggest enemy of investors is themselves. Fear, greed, overconfidence, regret. Index funds reduce decisions, and fewer decisions mean fewer mistakes. Automation beats motivation. Set up automatic investing and let life happen. No stress, no second guessing. This simplicity is powerful, and power compounds. Now imagine two paths. One path requires constant attention, news consumption, emotional control, and perfect timing. The other requires one decision: invest regularly and wait. Which one sounds more sustainable over 30 or 40 years? Real investing success is about staying in the game. Index funds make staying easy. Most investors quit because the process is exhausting. Index fund investors rarely quit because there's nothing to react to. This is why they outlast everyone, and in markets, outlasting is winning. Here's something most people don't realize. The biggest returns come after crashes. The investors who stay invested during fear make the most money. Index fund investors naturally stay. They don't guess bottoms. They don't panic sell. They keep buying at lower prices. This turns fear into opportunity without effort. Active investors freeze or flee. They miss the rebound, and the rebound is where fortunes are built. This pattern has repeated through wars, recessions, pandemics, and crashes. The market falls, the market recovers. The index keeps moving forward. Now let's address the criticism. People say index funds are lazy, but lazy is good in investing. Lazy avoids mistakes. Lazy ignores noise. Lazy allows compounding to work uninterrupted. The hardest part of investing is not doing something stupid. Index funds help you avoid doing something stupid. This alone puts you ahead of 90% of investors. And finally, this is about freedom. Index fund investing gives you time. Time to focus on your career, family, health, and creativity. You don't become a slave to screens or charts. You let capitalism work for you quietly in the background. This is real wealth building. Not flashy, not loud, but unstoppable. So when someone says they beat the market this year, remember, luck exists. But when someone beats the market for 30 years, remember, discipline exists. And discipline favors index funds. This is why index funds beat 90% of investors. Not because they are exciting, but because they are honest. And honesty wins in the long run. Now let's talk about randomness, because most investors confuse short-term success with skill. One good year makes people feel invincible. They believe they've cracked the code. But investing is not about 1 year or 2 years. It's about decades. In the short term, randomness dominates. Anyone can win temporarily. In the long term, structure wins. Index funds are built on structure. They don't rely on guesses. They rely on economic growth. And economic growth has a long proven history despite temporary setbacks. This is why patience beats prediction. Another hidden advantage of index funds is transparency. You always know what you own. There are no hidden strategies, no secret bets, no surprise decisions. You own the market, and the market is visible, measurable, and understandable. This clarity builds confidence, and confidence keeps investors invested. Most active strategies collapse because investors lose trust at the worst time. Index fund investors rarely face this problem because the strategy never changes. Now think about media. News thrives on fear and excitement. Markets up is boring. Markets down is dramatic. Active investors consume news constantly. This feeds anxiety. It pushes emotional decisions. Index fund investors can ignore headlines because nothing changes. The strategy remains the same. Buy, hold, repeat. This mental stability is not small. It's a massive advantage. Mental stability leads to financial stability. Let's talk about survivorship bias. We hear stories about investors who made millions picking stocks. We don't hear about the millions who fail. These failures disappear quietly. Index fund investing doesn't rely on stories. It relies on math, and math doesn't lie. When you include everyone, most people lose. Index funds accept this reality and choose the winning side of probability. This is humility in action, and humility is underrated in wealth building. Now consider innovation. Some people worry index funds stop innovation. This is false. Index funds support innovation by funding winners automatically. When new companies grow and succeed, they enter the index. When old companies fail, they leave. This natural selection happens without investor intervention. The index evolves with the economy. This adaptability is powerful. It means you are always invested in the future without predicting it. Active investors try to guess the future. Index fund investors own it. Let's talk about scale. The U.S. stock market has grown through every crisis imaginable. World wars, inflation, crashes, technology shifts, political chaos, and yet the long-term trend is up. This is not optimism, it's history. Index funds harness this unstoppable force. You are not betting on one company, you are betting on progress itself, and progress has always won over time. Now, here's a truth that hurts. Many investors don't actually want wealth. They want excitement. They want stories. They want something to talk about. Index funds offer none of that. They offer silence. But silence is where wealth grows quietly. The loudest investors are usually the poorest. The quietest investors are often the richest. This is not coincidence. This is behavior. Finally, let's talk about control. The illusion of control makes people trade more. They believe activity equals intelligence, but investing rewards inactivity. Index funds force inactivity, and inactivity lets compounding breathe. The less you touch it, the faster it grows. This feels uncomfortable at first, but comfort grows with results, and results speak louder than opinions. So, when you zoom out far enough, the conclusion becomes unavoidable. Index funds beat 90% of investors because they remove the very things that cause investors to fail: emotion, ego, fees, impatience. And what remains is simple ownership of growth. This is not magic. This is alignment with reality, and reality always wins in the end.